Derek is sitting on a mountain of cash, waiting. He isn't panicking, he isn't chasing anything. He's disciplined. He's holding out for the next major crash, and when everyone else is losing their nerve, he plans to swoop in and buy everything he can. Nora, meanwhile, drops $300 into an index fund on the first of every month and genuinely couldn't care less what the market is doing that day. New record high? She buys. Total chaos and panic? She buys. She might be the most hands-off investor alive. Both of them are convinced they've outsmarted the other. And over the next 40 years, one of them gets quietly, mathematically crushed, and it's the one trying the hardest. Because researchers actually tested this exact scenario using a perfectly all-knowing investor who buys the precise bottom of every single crash, and even that investor came up short. My name is Root, and today we're breaking down what actually happens when you only invest during market crashes, and why the answer should change how you think about the cash sitting in your account. Let's keep this comparison fair, because that's the only way it means anything. Derek and Nora are the same age, work the same kind of job, earn the same paycheck, and can both comfortably set aside $300 a month. They start on the same day with the same zero balance and the same type of account. The only difference is a single belief living in each of their heads. Nora believes the market is a slow, unglamorous escalator, and the only job that matters is stepping onto it and staying on, no matter which floor it happens to be on. Derek believes that escalator occasionally collapses into a fire sale, and the truly savvy move is to keep his cash dry and pounce the moment it does. And here's the thing, on paper Derek's plan sounds far smarter. Buy low. It's the first rule of investing, the one your uncle recites at every cookout like he personally invented it. Nora's plan, by comparison, sounds like she's barely trying. She buys high. She buys low. She buys on days that are objectively terrible, and she does it on purpose. One of these two is thinking things through. The other is relying on an automatic bank transfer. Hold that thought, because in about 40 years it's going to matter a lot less than you'd guess. So they begin. For the first long stretch, Derek looks like a genius in waiting. The market does what it usually does, grinds steadily upward in a way that feels almost rude to anyone hoping for a discount. Nora's $300 goes in every month and buys slightly fewer shares each time as prices rise. She isn't thrilled about that exactly, but she's also not thinking about it, which turns out to be the entire point. She set the whole system up on one lazy Sunday afternoon, picked a single broad index fund, flipped on the automatic transfer, and basically forgot her login information. The confirmation emails pile up unread in a folder she's never opened. Derek, on the other hand, is watching. He's got a watch list. He refreshes it constantly. The market climbs to a fresh all-time high, and he actually feels good about it, because in his mind every new high just means the eventual drop will be bigger, and his entry point will be that much sweeter. He tells his friends he's waiting for a better opportunity. He says it with the calm certainty of a guy who's read exactly one biography of a famous investor. Then more time passes, and the crash he's been waiting for simply doesn't show up. This is the part the buy the dip daydream never accounts for. So let me put an actual number on it. From March 2009 to February 2020, the market climbed for nearly 11 uninterrupted years without a single bear market. 11 years. Over that stretch it gained somewhere around 400%. Now picture Derek sitting through the entire run with his money parked in a savings account, refreshing his watch list, muttering that it can't possibly keep climbing, watching the metaphorical truck he was going to back up rust away in the driveway. Every single month, Nora keeps buying. Every month her money compounds on top of last month's money, which is compounding on top of the month before that. And every month, Derek is being patient, which is a very polite word for doing absolutely nothing while the most powerful force in finance works for somebody else. Here's why timing matters this much, and it's the statistic that should make you a little uneasy. The market spends most of its existence at or near an all-time high. Since 1950, the S&P 500 has closed at a record high on roughly 7% of all trading days, and almost a third of those record highs turned out to be permanent floors. The market never dropped below them again. Think about what that means for Derek. Waiting for a dip usually means, in practice, waiting for a price you're never going to see again. The market finishes positive in about 3 out of every 4 years. So Derek isn't gambling on a coin flip. He's betting against a rigged coin, over and over, with his own future riding on it. But maybe you're thinking, sure, but when the crash finally arrives, Derek swoops in and makes it all back in one heroic move. Fair thought. Let's actually test it, because someone already did, and the outcome is genuinely hard to believe. A major brokerage firm ran a study on exactly this. They examined 20 years of market history and tracked a handful of investors who each contributed the same amount of money every year. 3 of them matter here. The first had flawless timing. Every single year this investor magically bought at the exact lowest point, the single best day possible, for 2 decades straight. The second simply fed the money in evenly as it came, no strategy, no hesitation, basically Nora with a different name. The third did exactly what Derek does, held cash, waiting for the ideal moment that always seemed to be just around the corner. Now, before revealing the results, guess where the cash waiter lands, because most people assume the gap between perfect timing and everybody else is massive, and that sitting on cash is at least a safe middle ground option. The perfect timer, the one who nailed the bottom every single year for 20 years, ended up with roughly $186,000. Nora's no strategy approach, just feeding money in as it showed up, ended up with about $166,000. So 2 decades of literally flawless, godlike timing beat barely trying by only around $20,000 total. That's the whole gap. The single greatest market timer who has ever existed edged out a woman on autopilot by roughly $1,000 a year. And the cash waiter, Derek's approach? $47,000. Not a typo. The patient genius keeping his powder dry ended up with barely a quarter of what the woman who never once checked her account earned. And here's the gut punch, the same study also included one more investor, the unluckiest person imaginable, who bought at the exact peak of every single year, the worst possible day, every time. That cosmic disaster of a portfolio still tripled the cash waiter's total. Read that again. Buying at the worst possible moment every single year, on purpose, beat waiting for the perfect moment by a factor of 3. Being invested on terrible days was a rounding error. Not being invested at all was the actual catastrophe. And that's just 20 years. Stretch that same gap across a full lifetime, and it stops being sad and starts being almost comical. $100 invested in the market back in 1928 would be worth well over $1 million today. That same $100 kept safely in cash the entire time would be worth about $2,500. Same starting amount, same century, except one path leads to generational wealth, and the other barely covers a nice dinner out. Every year Derek spends waiting, he's essentially choosing the dinner. Now, if I stopped there, you could fairly argue that none of those investors had a crystal ball. Derek's whole bet is that he'll spot the crash and everyone else won't. So let's hand him the crystal ball. Let's actually make him a god. A finance writer named Marcus Fielding ran what might be my favorite study on this entire topic. He built a buy the dip strategy with perfect, all-knowing foresight. This imaginary investor saves cash every month and deploys it only at the exact lowest point between any 2 market highs, the precise bottom, every time, with perfect knowledge of the future. Then he compared that all-seeing dip buyer against a boring dollar-cost averager who just invests the same amount every month and never checks. He ran this test across every 40-year stretch he could find, going all the way back to 1920. The boring, mindless monthly investor beat the all-knowing god of market timing more than 70% of the time. Let that sit for a second. Even with perfect knowledge of every future bottom, the dip buyer lost in roughly 7 out of 10 cases. And it gets worse, because that's the version where you're all-knowing. The moment you make the god even slightly human, the whole strategy collapses. Fielding found that if you miss the exact bottom by just 2 months, the dip strategy loses to plain dollar cost averaging 97% of the time. You go from winning 30% of the time with perfect vision to winning just 3% of the time with vision that's off by a few weeks. And real people, the ones staring at a screen full of red, aren't off by 2 months. They're off by a country mile, usually in the wrong direction. Why does this happen? Why can't even a god beat someone who isn't even trying? It comes down to one quiet, brutal fact. While the dip buyer's cash sits there waiting for the perfect moment, it isn't earning anything, and the market keeps drifting upward the entire time. The bottoms you're waiting for are rare, and they almost always sit at price levels higher than where you could have simply bought years earlier. In that 1995 to 2018 example, the single purchase the dip buyer made at the March 2009 bottom accounted for over half of their entire final portfolio. Half. The whole strategy lived or died on nailing one purchase, on one day, perfectly right, in the middle of the scariest financial moment in 80 years. And if you'd hesitated even slightly, the way every real human being would, that half would have vanished. Quick aside before we continue, because this is exactly the kind of counterintuitive money math we dig into constantly inside our community. If you're the type who likes seeing the real numbers instead of cookout wisdom, there's a link down below, and feel free to skip it entirely if you'd rather just keep watching, no pressure either way. So let's tally what else waiting costs Derek, beyond the lost dollars we already watched pile up, because the crash discount he's dreaming about is the only number he ever pays attention to. There are two more hidden costs underneath it. The first is that the crash never arrives on schedule. Corrections of around 10% show up roughly once a year, sure. But real bear markets, the 20% plus drops Derek is actually holding out for, only come around every 3.5 years or so, on average. And only about 1 in 4 corrections even turns into one. So Derek isn't waiting for a bus that's running a little late. He's waiting for a bus that might not show up for a decade. And while he waits, everyone who took the escalator is 3 floors higher. The second hidden cost is the cruelest one, because it's psychological, and it's the one nobody thinks applies to them. Buying when everyone else is terrified sounds heroic right up until the moment you're the one who's terrified. Now, here's where I have to be honest with you, because if I only showed you the case against waiting, I'd be doing exactly what the lazy index fund crowd does when they pretend timing never matters at all. It does. There are real, specific situations where holding dry powder and deploying it into a crash is spectacular, and they're worth understanding. When a severe crash hits and you actually buy near the bottom, the returns can be life-changing. Someone who bought at the March 2009 low earned a roughly 17.5% annual return over the following 10 years. Someone who bought near the March 2020 COVID bottom saw the market hand them around 25% a year for the next 4 years, and that includes the rough patch in 2022. If you look across the last 13 bear markets, the average return in just the 12 months following the bottom was about 47%. So no, dip buying isn't foolish. When it works, it's the best trade of your life. The catch is that people who actually bought the March 2009 bottom are about as common as people who leave a casino richer than they walked in, and roughly 10 times louder about it. There's also a legitimate, disciplined version of this strategy that isn't crazy at all. If you already have a lump sum or you're rebalancing a portfolio and steering money back into stocks while they're down, that's not cash hoarding, that's using money that was always going to be invested in being smart about the timing of a confirmed, deep decline. The mistake was never buying low. Buying low is great. The mistake is 2 specific things. 1, you can't reliably know when the actual bottom is, and being off by even a little wrecks the entire edge, as we just saw. 2, the crash you're staking your future on might be 11 years away, and the opportunity cost of waiting almost always swallows whatever discount you eventually receive. Derek isn't wrong that crashes are buying opportunities. He's wrong that he can afford to sit around waiting for them. And this is where the whole thing comes back down to earth, because everything we've discussed so far assumes Derek behaves perfectly the moment his chance finally arrives. He won't. Almost nobody does. And we actually have the data to prove it. There's a research firm that has tracked how everyday investors actually behave for decades, not how they claim they'll behave, how they actually do. And the picture is grim. In a recent year where the market returned about 25%, the average equity investor earned around 16.12%. They left more than 8 percentage points on the table in a single year, purely through their own decisions. And the giveaway is what they did during the scary stretches. They didn't buy the dip. They pulled their money out. In fact, investors yanked money out of stock funds in every single quarter of that year, with the biggest withdrawals landing right before the market ripped higher. That's not a one-time fluke either. By that point, it marked 15 straight years of the average investor underperforming the very funds they owned. It's the financial equivalent of hiring a 5-star chef and then torching the meal yourself on the way to the table. Sit with how badly that wrecks Derek's plan. His entire strategy depends on him being calm, rational, and aggressive at the exact moment when the actual evidence says human beings are terrified, frozen, and selling. The crash isn't a green light flashing by now. It's a wall of red headlines, a retirement account down 40%, a spouse asking if you should just get out before it hits zero, and a very loud voice in your head agreeing with them. The buy the dip strategy demands the most courage at the exact moment you have the least of it. It's a plan that only works if you're a robot, and the data makes it painfully clear that you are not one. Nora never has to be a robot. That's the quiet beauty of what looked, at the start, like the dumber plan. She doesn't need to be brave during the crash, because she's already buying. She doesn't need to call the bottom, because she's buying all the way down and all the way back up. When the market fell, her $300 that month bought more shares at lower prices automatically, with zero courage required. She turned the scariest moments into her best purchases without feeling a thing, because she took herself out of the decision entirely. The discipline Derek was so proud of, the patience, the watch list, the waiting, all of it turned out to be the expensive part. Nora's secret was that she never gave herself the chance to be clever, which meant she never gave herself the chance to be wrong. So after 40 years, here's where our two investors actually land. Nora, who never timed a single thing, who bought on the worst days and the best days wearing the exact same blank expression, is sitting on a portfolio that compounded relentlessly for 4 decades. Derek, who was patient, disciplined, and genuinely more market savvy than 90% of people, spent years on the sidelines, missed the biggest run of his lifetime, and even when he finally did buy, never quite nailed it the way the fantasy required. They both started in the exact same spot, with the exact same money, chasing the exact same goal. One of them simply refused to let cleverness get in the way. And that's the real trap, the one this whole video has been circling. It was never stocks versus cash, or patience versus recklessness. Derek and Nora both walked in believing the secret to investing was being right about the market. Derek thought the edge was in timing it perfectly. Nora, almost by accident, proved the edge was in never needing to. The trap is believing that cleverness is the whole point, that there's some perfect moment out there worth holding out for, when the math keeps screaming that the moment is right now, and the only people who actually win are the ones boring enough to keep showing up. Now, I can already hear the obvious follow-up question: what if you did both? Kept investing every month and kept some dry powder ready for the genuinely historic crashes, because there is a version of that which is completely defensible. And the line between smart rebalancing and Derek simply fooling himself is thinner, and more interesting, than you'd expect. But that's a conversation for another day, and the math behind it might surprise you even more than what you just saw. For now, the next time somebody tells you they're waiting for a better entry point, that they're holding their cash ready for the next big crash, just ask them one question: how long are you willing to wait? Because the market doesn't owe you a crash. And while you're waiting for the perfect moment, the only thing actually compounding is the cost of waiting for it.